Hello, everyone, and thank you for joining us for another episode of the Financial Commute. I'm joined by Bruce Tyson, Wealth Advisor and partner here at Morton Wealth. Bruce comes to us with almost 40 years of giving investment advice to clients. He's been through a lot. You and I are both kind of investment dorks. We love to talk about investments and what's going on in the markets. One of the things that's come up recently is the fact that the Federal Reserve has kept interest rates low for so long. Safe money was earning zero for the last 10 to 14 years, that it caused clients to go farther and farther out on the risk spectrum to try to get their money to work for them.
Right.
And it caught some people by surprise this year, now that interest rates have moved up, inflation has been sort of a fear out there. Stocks have come down anywhere from 18 to 25% for the year. Bonds or fixed income, safe money is down, call it, low to mid teens. And it's caught some people by surprise. Tell us a little bit about like what you've seen in your life over the years in terms of crises and recessions and that.
Right. So I've been through the '87 crash, the internet bubble bursting in 2000. There have been, the great financial crisis in 2008 and 9, and then we had a market dislocation in 2015, 2018, 2020,
Right.
and now here. And I see there's been lately there's been a compression of volatility, and it's seems like every couple of years.
Yeah.
And I've been in this business now over 40 years, and I think about how many 2-year periods have I been through?
Right.
I've been through, depending on how you're counting, I've been through at least 20 2-year periods.
Right.
And they go by pretty fast.
Yeah. They make things interesting. I mean,
Yeah.
obviously, there are opportunities that come out of any one of these 2-year periods that are interesting.
Right.
Keeping interest rates at zero for so long, the only probably good thing about it was people could borrow money or refinance their mortgage very, very cheaply. And it
Right.
feels like free money. I mean, if you've got a 2.5% or 3% mortgage and inflation's at 7%, or you can earn 4% on a short-term U.S. Treasury right now, you feel like it's free money.
Right.
What do you think some of the other risks that people face now that the Fed is raising interest rates and we're seeing some volatility in the markets?
Well, one thing we're facing is recency bias. So we think whatever happened yesterday is just going to continue.
Right.
And that typically, does not happen like that. So people are very fearful because the market's dropped quite a bit.
Yeah.
Both the stock market and the bond market have dropped quite a bit. And particularly the bond market is down in the last 50 years. This is the worst year by a long shot.
Right.
And so people think it's just going to keep going. That tends not to happen. And now that we actually have interest rates that we can invest in.
Right.
One of the problems we've had over the last decade or so is that retirees, other savers, they couldn't earn really any money, and so they would take more risks and be led into things that really didn't make sense for them.
Right.
High risk investments that had no cash flow, just the hope of of making money.
Yeah.
In fact, they did make money. Some made money, and then they gave it all back.
Right.
As interest rates rose, that meant that the calculation of the math of how to value, say, for example, the stock,
Yeah.
that dictated that as interest rates rise, stocks are worth less.
Yeah.
It's just math. And most people are not aware of that. And so that's been, so people round tripped a lot of their possibly good investments
Right.
early on.
I mean, last year was interesting. I mean, the U.S. market was up 27%, sort of out of nowhere. I mean, people made a lot of money in stocks last year, and then now this year they've pretty much given back all those gains.
Mhm.
But the big fundamental shift has been around inflation, raising interest rates, and so short-term U.S. Treasuries went from yielding almost zero to about 3.5% to almost 4% today. So there really is opportunity for investors
Right.
to earn something with safe money.
Yes. And the flip side of that is that because rates were low, certain institutional investors, the big pension funds, and you saw this happen in England in October, a lot of if pension funds, mostly the big defined benefit plans, they have to earn, usually they try to earn 7%.
Right.
That's their bogey. And they've been able to do that with stocks, but with interest rates super low, you can't make 7% on bonds if interest rates are 2%.
Right.
So what they would do is hire out hedge funds to lever it up. So borrow, like for every $1 million they invested, they were going to borrow 3.
Which is not a problem if you can borrow at 0, right?
Yeah, you can borrow it. You can borrow low. It's great. You make your bogey.
Yeah.
But if interest rates suddenly spike and the bonds you bought drop a lot in value, then you get margin calls.
Yeah.
And that was what happened in England. And just because the drop was so great, it was outside of the band of what the hedge funds thought they could protect against.
Right.
So being levered up with low interest rates can be problematic because, again, there's this misallocation of capital. People don't really expect, they don't really understand ramifications if things don't go right.
Yeah. So it's November of 2022. The Fed, inflation is still a headline risk that the Fed is trying to solve for. They're meeting this week to talk about, raising rates again. I think consensus is somewhere around 50 basis point rate hike or 0.5%. Some people might be thinking that it might be 0.75% or 75 basis points. At what point do you think the Fed might stop or pump the brakes on raising rates at the fear of the market falling, or do you think that they're not really concerned with that?
I think they're concerned with it, but I think they want to show that they're strong because they made so many mistakes leading up to this.
Right.
I mean, this whole idea that inflation was transitory, that was a pipe dream. And you had some voices like Larry Summers, who used to be Secretary of the Treasury. Yeah. He was saying as an outside voice that start raising rates in 2021, and he was poo-pooed. And so some of the people that are in power now, Jay Powell and Janet Yellen, they're kind of trying to show that they're tough now when they weren't tough before.
Yeah.
So I think there's a pressure on them to stay tough, but also they don't want to get, again, behind the curve on the other way. So I think, it's tough to know exactly, but I think we'll see 75 basis points this month in November. The next one, December, it's a tough call between 50 and 75.
Yeah, I was talking with a mortgage broker the other day. Obviously, borrowing money to buy a home is a lot more expensive today than it was at the start of this year. But they think that, in 2023 or 2024, there might be an opportunity to refinance at a lower rate. Maybe if we were to head into a recession, there's a hold on rates or they even come back down. But when you're talking to a client, something that comes up a lot lately is inflation's high. My stocks and bonds are down. I know we leverage a lot of alternatives to help protect clients and generate a lot of cash flow. But what are you advising clients to potentially do right now going forward in their ability to, protect themselves against inflation, generate income to maintain their lifestyle and support, the future generations that they have? What sort of advice are you giving them right now?
Well, I'm looking at the investments they have, and let's just say for the portion of their portfolio that's in fixed income, if it's not yielding much, you could look at some longer dated investments because rates would be higher. There's some good, some mutual funds that are bond funds that are well managed, and those funds are doing some of the internal shifting for you. You don't have to be, sophisticated.
You don't have to be a bond trader.
You don't have to be a bond trader. That these people are doing it for you.
Yeah.
So obviously we're employing some of those. I probably, would not make any dramatic shifts right now. We've kind of gone too far, and I'm not sure we've hit. We haven't hit bottom on stocks yet, but it's hard to know. But I think we've probably done most of the damages have been done. And as things move up, which they will at some point, I think you reevaluate and see where you really want to be with what your objectives are. Do you want income? Do you want growth? What are your objectives? Yeah.
So what you've been, again, advising on clients and then working with colleagues over the last 40 years on various turbulent market cycles. What do you think is the biggest key for investors to have in order to be successful going forward in dealing with crisis or recessions that we're potentially heading into?
Don't panic.
Don't panic.
Keep your head about you. If you want to be in good investments generally.
Yeah.
Okay. If you're in a good investment with good management, typically that will work to your advantage, as opposed to buying more speculative things where some of the investments that I saw people buy back in the tech bubble,
Mm-hmm.
those companies vanished.
Yeah.
So you might see, the NASDAQ was down 80 or 90%, but then ultimately it came back and over time surpassed the old.
Took 15 years.
It took 15 years. But if you were in one of those, if you bought the index, fine. If you bought some of those speculative companies, they never made it back.
Right.
And so I think broad diversification through some kind of fund or just some gigantic company like a Microsoft
Right.
or a Google.
So the key to investing in this environment is high quality. So
Yeah.
if you're investing in stocks, you want stocks that have really good balance sheets and actually generate a positive, cash flow.
Right.
They're not having to continue to borrow or issue stock to stay alive. They actually have positive cash flow come in,
Right.
maybe potentially pay a dividend to investors.
Right.
That would be high quality from a stock perspective.
Right.
From a bond perspective, what does that look like?
Again, you want some flexibility. I mean, some of the things that we invest in have floating rates. So as rates have risen here,
Mm-hmm.
we're getting paid more.
Yeah.
So that's helpful. I think some of the problems in the bond indexes, there are problems in the bond indexes. So you really need to know what you're investing in. So for example, in the stock market,
Yeah.
if you look at the S&P 500 or any other big index fund,
Yeah.
the biggest market capitalization companies, so Microsoft, Google, was Facebook,
Apple.
but Apple,
Yeah.
they're the biggest components. And in the bond market, the biggest bond funds are the composition is made up. The biggest elements of that composition are the companies with the most debt.
Yeah.
So the worst, I'll use a nice word, the worst
The
companies.
least healthy company.
So yeah, the biggest debtors
Yeah.
are the biggest components of, say, the corporate bond index
Yeah.
fund. There are some corporate, investment grade corporate bond index funds have done terribly this year
Yeah.
because the biggest components are poor, highly indebted companies.
Yeah.
So you need to know what you're owning. So again, stay with quality. And just because it says investment grade, it doesn't mean it's quality. A huge chunk, it might be as much as, I don't know the number, but as much as half, let's say, of the investment grade bond index are BBB bonds, which are one notch above junk.
Right.
And if they get downgraded, now you have a whole bunch of junk stuff.
Yeah.
So that's one reason why that investment grade bond fund dropped more than the index this
Drop
year.
more of the index. Yeah.
Yeah.
You mentioned diversification and patience being two important things. How easy is it to find diversification using traditional assets these days, like stocks and bonds?
You can diversify across different asset classes. Within stocks, it's not just the S&P 500.
Mhm.
As we know from last year, the top 10 stocks comprised 30% of the whole index, while the bottom 100 was barely the same as the most valuable company.
Right.
So the bottom ones don't get any play. So you want to have diversification across types like growth, value, large, small, international, some international in there too.
Right.
I mean, you just don't know. I mean, the decade from the first decade of the century,
Right. 2000 to 2010.
yeah, international did great.
What was it?
Value-
Close to 9%
Yeah,
annualized?
right.
And then the U.S. market was flat.
Yeah, and the U.S. market was flat.
Yeah.
And last decade the U.S. market was great, but going into this decade, it could flip again.
Yeah.
So you never know what's going to happen, and there are just so many things that are going on with the dollar getting super strong. That's confounded things. I mean, gold's is a diversifier, and people in this country, in the U.S. think, well, it hasn't done that well this year, but in but versus the euro, the yen, the pound, the Chinese currency, gold is up against all those.
Right.
Because there's a need for people, they want to own
Yeah.
something that's sort of transportable. But the dollar's been so strong this year that's gold hasn't been great this year. But
It's fascinating that gold denominated in any other currency than the US dollar, it's
Right.
actually positive for the year.
right, and Turkey was up 30%.
No
Turkey.
kidding.
Yeah.
Yeah.
So it's so you never know which is the one place to be. What you want to be in, you want investments that are strong and that that are high quality.
Yeah.
And that's probably high quality and staying power, probably the two most important things.
Yeah. What other asset classes beyond stocks, bonds, or potentially gold do you think that investors should consider looking more further into to help diversify or generate cash flow or even possibly even grow?
Well, there's real estate.
Okay.
That's been historically been a great investment. There are public real estate funds like REITs that can do well.
Real estate investment trusts.
Yes. There are private real estate funds. Those are tougher because it's hard to evaluate those.
Yeah.
Again, you want to go with track record there, and you want to avoid a lot of those funds have huge amounts of fees involved, so you want to avoid that. We're doing something with whiskey barrel aging, which is pretty esoteric, but
Right.
there are if you work with seasoned professionals, those can be available to you.
So again, going back to the biggest takeaways, in times of volatility, it's important to stay patient, really evaluate your needs, whether you need growth or income, and then working with your advisor to have a diversified approach to combat those challenges that you're facing in terms of needing to beat with inflation or generate the income that you're looking for. Bruce, it's been a lot of fun having you on. I feel like we could talk for hours about all the different things that people can do. Well, not unless you want. If there's any other points you'd like to make.
No, I think that's good. I think it's a good roundup. Yeah.
Perfect.
Good. Okay.
Thanks, Bruce.
Well, thanks.